Is commercial property the future? Check out this video as I explain why I think it is. Hi, my name is Simon Misiewicz.
And I'm Louise Misiewicz.
And we're from Optimise Accountants, helping you invest in property in the UK in the most tax efficient way. If, however, you are British, moving or investing into the United States, why not check out the Personal Tax channel to help you save tax across the Atlantic. Also, we have a fantastic opportunity for you to join me and many other property expert panel members, from mortgage brokers to solicitors to LMPG, NRLA, surveyors, to help you invest in property in the best way possible. You can join us, the Property Experts panel, on the first Monday of every month at 7 p.m. A link will be below this video description for you to register today.
So before we start exploring how commercial properties can be perhaps one of the most tax efficient ways to invest in property here in the UK, let's talk about what commercial properties are. The first perhaps is one of the most obvious, and that is actually things such as shops or retail units. These are things you'll see on the high street or the side high street, and there'll be units that allow people to retail their products and services directly to the public. The second area, of course, of commercial properties is that of factories and warehouses, maybe even logistic depots as well. So items, again, where people are working, perhaps not retail focused, but certainly creating and manufacturing either goods or potentially service elements as well. Third and final is the office. The offices that we know and love around the country that you might argue recently have taken a bit of a drubbing with regards to COVID-19. But offices nonetheless are also great commercial property examples. So let's just talk about some of the tax efficiencies you can generate from a commercial property, either item or portfolio. We're going to look at probably the four biggest areas that we certainly think bring massive tax efficiencies to our landlords who invest in such items. The first is something that's been a relatively recent tax issue for most residential landlords, and that is Section 24. The great thing about a commercial property is that whether it's owned in your personal name, in a partnership, a trust or a limited company, there is no Section 24 issue with regards to mortgage interest and how it's treated for tax efficiency, which is fantastic. That's exactly what you really need right now, things to help minimise your tax bill. Additionally, such commercial properties may be purchased within a pension, such as a SIP, perhaps even a SAS. And to understand more about this detail, we're not going to be able to jump into masses during this particular video, but if you want to find out more beyond what we do share here, then of course check out our articles and videos on this topic. So, a SIP, a SAS, or perhaps another style of pension, being able to buy your commercial property. Fantastic, considering in residential units you just simply can't do that. The third area of great advantage is when it comes to purchasing the asset, and that really painful, nasty tax called stamp duty land tax. Well, sadly, you're probably still going to have to pay it with a commercial property just as you would with residential. But the good news is you pay a different level of stamp duty land tax, and more on that in just a couple of minutes. Fourth and finally is capital allowances. And again, we will go through this on this video, but capital allowances is a method of adding up certain types of expense you incur on the property that historically, if you're looking at a residential portfolio, wouldn't be available to you to minimise your in-year tax bills, but because it's not residential property, you can use those expenses to minimise that in-year tax bill, which is fantastic news again. So not only are you looking at tax reliefs when you buy the asset, you're also looking at tax reliefs the whole time you're running the asset for money.
As Louise talked about earlier, there is something called a stamp duty land tax. This is the tax that you pay whenever you buy anything to do with land. And in this particular regard, we are going to be focusing on commercial property against residential property, because I think it's fair to say that most people watching this video will say, get on with the residential property investment bit. But actually, we want you to take a little bit of a breath and think about how commercial property investments could really work for you. The first element of tax is stamp duty and land tax, and we have a beautiful article for you to read. There is an article linked below, so make sure you click on that to get more details. But what I want to reference is this particular table, and please note there are a couple of omissions. The first omissions is the stamp duty land tax holiday period, which Rishi Sunak introduced in 2020 and obviously is still being played out in 2021. So we are ignoring that because we hope that this video will go a long period of time afterwards. It also ignores the foreign surcharge for SDLT at 2%. So we are purely focusing this on the fact that you have got the stamp duty land tax rates plus the 3% SDLT high rate for residential properties. I'm not going to go into masses amounts of detail here because you can see the table of information. But what I want to highlight to you, once the holiday period is finished by Rishi Sunak, then indeed you will pay more stamp duty land tax buying a residential property than you would a commercial property. So if you're looking to save tax and have a good investment as well, well then maybe, just maybe, a commercial property is better for you. Wondering how much stamp duty land tax you'll have to pay? Well, the thing is with stamp duty land tax, if you go to a conveyancing solicitor on High Street who profess to be an SDLT specialist, they're not, then you will pay more SDLT than you really need to. So make sure you download the SDLT calculator to double check what your solicitor is telling you to pay. There are some great tips in that calculator to save that tax liability as well. The second tax that I want to highlight is Section 24 mortgage interest relief cap. Try saying that once you're a little bit tired or a glass of wine on a Friday. But what is Section 24 mortgage interest relief? Well, if you've been to sleep a long time, then you may not understand what it is. But ultimately, it's the amount of interest, mortgage interest I'm talking about, that can be offset against your rental income. Well, we are now beyond the point of it's being phased in. It's fully enforced. So that means that as a residential property investment, you cannot offset the mortgage interest cost against your rental income. Let me restate. You cannot offset the mortgage interest against your property income, which basically means you pay more tax as a result. The Section 24 mortgage interest relief cap does not affect commercial property. Whether you buy shops, warehouses or offices, then this particular tax stranglehold of your properties and portfolios is not going to be affected. Okay, so it's a great way to save not only stamp duty land tax that I've highlighted, but also income tax in regards to Section 24. I have provided a link below the video description about Section 24 mortgage interest relief cap. So make sure you click on that link and get all of the gory details. So hopefully you found this particular section very useful. If you have, make sure you press that like button because we want to make sure that everyone else knows it's a good piece of content for you to save tax. Don't forget to subscribe to this channel so that you get notified of every new video we release. And of course, if you have any questions whatsoever, maybe about tax, not your dog, then please make sure you comment into the section box below here and we'll get back to you. Of course, you may want some more specific advice and guidance around commercial property, setting up your structure, should you use companies or not, how to minimize stamp duty land tax, which is a complex area. All of this kind of stuff we can help you with. Make sure you book a tax consultation with us for 30 minutes. That's all you need really for this type of subject, and use the code YouTube25 to get your 25% discount. The link to book the call is below this video, so go ahead and book that call today, save tax tomorrow.
So So Simon has already covered 2 additional tax reliefs that really make commercial property sing and stand out perhaps in comparison to residential, and that of course was stamp duty, land tax and Section 24. I'm going to talk to you now about capital allowances, and capital allowances will apply to commercial property but not necessarily or very rarely on what you and I would call residential property. So let's have a look at capital allowances, and I've attached an example here of a table to really run through the types of expenses that you might see on a typical perhaps refurbishment or property and compared it between a residential unit and a commercial unit. The long and the short of this is simply to bring to life the fact that more of the costs that you incur on the commercial property are going to potentially enable you to minimise your tax bill every year based on the fact that you can apply them as capital allowances. Now, for some clients, they're going to need a specialist capital allowance report to really get into the nuts and bolts, if you want to call it that, of the detail of what the fittings and items are within the property that will attribute to a capital allowance report. The critical thing here is that it's about making sure you understand the detail and bringing in the right people to help you get to that detail if it's not a skill set you have. Commercial properties and capital allowances are a great opportunity, and more of our clients come to us not understanding it, so that when they do speak through the detail with us and really get a handle on how it can help them, then we can help them save masses of tax, and that's exactly what you can do as well with a commercial property.
Just on that point, Louise, let's imagine that we have a situation whereby someone has indeed got a capital allowance report. They've done it straight away. They've got their annual investment allowances, etc. But it's created a loss. What do people do with those losses?
So a loss, quite frankly, is not something you're going to lose out on. No pun intended, I promise. But what it does is it allows, in certain circumstances, you to use that loss against other forms of income. So if you have a salary, let's say, as well as a commercial property portfolio, you might be actually able to get some of your tax back from your salary and taxed salary at that. So it's a massive opportunity. Equally, if you can't do that or the allowances don't enable you to do that, that loss will carry forward to the next year against those properties and help minimise your tax bill for those properties for future years. So you don't lose out on losses and how they can apply, nor indeed when they can apply to.
And hopefully you haven't been lost in that transaction. Oof, I'm so sorry. Right, let's continue with what we're talking about here and commercial property investments. Louise, we ought to talk about SIPP pensions. I think SIPP pension is a fantastic way because there are so many tax advantages of contributing towards a pension, but also to own properties in that pension. Do you want to take us through a run chart?
Sure. So for me, the real advantages of a pension is that you can load money into a pension very tax efficiently, in fact, tax-free for most of us. And anything that you then invest in within that pension can grow also tax-free. So let's say you've loaded in some money into your pension, perhaps taken from salary, which hopefully will have saved you some tax already. You then use that money to go and buy a commercial property, which you then rent out. And all of the rental income that you acquire from that property's rent will load also inside the pension, which will now grow completely tax-free. So it's a fantastic opportunity to broaden your portfolio investment in property activities, not just perhaps in your personal name or a partnership or indeed a limited company, but in a very tax efficient vehicle, which of course is the pension itself. So it's a fantastic methodology to consider. And let's be honest, you've built up lots of knowledge and lots of understanding and expertise in how to make property portfolios profitable. Why not make it profitable with no tax?
And let's, again, just as an example to bring this to life, but if you are a business that is professional services, you're in an office, or you are a medic, as a great example here, whereby you have a premises that you run from and you have other doctors that accompany you in these practices. why not own those buildings? Because there's a double whammy benefits here. First of all, if you are in that building, you can charge your company or your business a rent from your SIP pension, and the rent can go into your pension tax-free. So not only have you got a corporation tax saving or income tax saving on the rental charge, but that money is now gone into your pension. And you can also, if you're a doctor, as I mentioned earlier, you could charge your other colleagues rent, which they will pay into your future pension, which again will not be taxed whilst it's in the pension itself, only taxed when it comes back out again. Would you think that's a good idea for most people to consider when they're thinking about commercial property against residential?
Absolutely. For many of our clients, a portfolio property, whether that be commercial, residential, or a mix of both, is there to build a pension. Well, why not use a tax-efficient pension vehicle to help you grow that portfolio and manage it as tax efficiently as possible? So, if you're liking the sound of the tax efficiencies, please hit that like button, press on the subscribe button, and share your comments below, and we'll do our very best to answer them for you as well.
Until the next time, my name is Simon Misiewicz.
And my name is Louise Misiewicz.